everyone, and welcome to UBS Trending. I'm Anthony Pastore. During periods of volatility, investors look to the Federal Reserve to balance out the economy. And in this particularly uncertain market, Jay Powell, the head of the Fed, has a lot of thinking to do. And with that in mind, and our expectations, what should you know? So luckily, we are joined today by my friend and colleague, senior fixed income strategist with the Chief Investment Office, Leslie Falconio. Leslie, always good to have you here.
Thank you. Good to have
you. Interesting markets, to say the least.
Very.
A lot of uncertainty as we keep talking about, and it continues. Okay.
No question.
So you wrote a recent fixed income strategist report. You titled it Hawks at the Helm, which I love. I'm sure you're going to explain that for our viewers in a moment. But let's talk about inflation. It's continuing to rise. It's only getting more and more, what's the word I'm looking for? Invading our markets, invading consumer goods. We've seen what happened with the prices of oil, although that's fluctuating with the quarantine situation in China. But consumer goods in general are going up. So following the expected moves from the Fed, which we know that Jay Powell raised rates 25 basis points last month, but we've got two more coming, June and July, and you and the Chief Investment Office expect 50 basis points at each meeting. You call that a nowhere to hide environment. Talk about that, because I love the way you describe it in the report, but I want you to explain it to us here, because it's a very interesting concept.
Well, you know, the nowhere to hide actually came from what we experienced in the first quarter. And to your point, when we think about the shifts that we've seen in the Fed fund projection, what the market is expecting, you know, we've moved from what was expected to basically be 3 rate hikes for all of 2022, right, to now about 7 or 8 rate hikes. Right. Now, as you pointed out, they've gone 25. The market is expecting May and June of 50. But we've had this really large rise in interest rates, as we all know. The 10-year, let's just talk about the quarter, because it's higher now. But if we just look at the first quarter, the 10-year went from 1.5% to 2.5%. We've made these decade, lows in the Treasury market in terms of total return, down 6.6%. But the equity market was already down, was also down. So when you look at this nowhere to hide, that's really what we're referring to. Now, going forward, because the market is pricing in this hawkish sort of outlook, because the market is pricing in quantitative tightening, the opportunity set might be a little bit better in terms of the headwinds of rising rates.
Right. So it is about balancing the economy for the Fed right now. And inflation remains their biggest mandate, which that's basically the only thing we talk about anymore, is how inflation continues to rise. So Hawks at the Helm, perfect title. I love it. So nominal yields, though, I want to talk about that with you, because they have spiked, but real yields are still negative, which you talk about in the report. So we can't call inflation transitory anymore, because it seems like it's certainly here to stay, at least for a time. And CIO is expecting that to maybe balance out at the end of the year, but that could be changing as we speak, because so much is changing in the markets. So what is the expected outlook for inflation from the Chief Investment Office?
Well, I mean, we have CPI this week, right? And it's supposed to be around
8.5% or so,
which we expect to be the peak. We do expect to be the peak. But even if we look to the end of the year, 22, right, the headline CPI would still probably around, let's say, like 3.5%. Maybe in 23, it falls to, at the end of 23, falls to that 2% level, which is, the Fed target. But the market doesn't really expect inflation to hit the Fed target in 2022. And to your point, they've taken away that transitory, because they've come to realize that not only is it about inflation that we're seeing because of these post-COVID supply-demand impacts, or even some of the sanctions from Russia and Ukraine, it's also about housing. It's also about wages. So a lot of these sort of inflationary headwinds that we think will, last for some time. And one of the reasons why the Fed is hiking so aggressively, and we talked about this in the last segment, was, we know that hiking rates won't do anything for supply chain bottlenecks or sanctions, but it can push consumer demand down. And that's the way they want to balance the economy.
Right. You look at the 30-year mortgage, it's gone up ever since Powell raised by 25 basis points.
Some of the biggest percentage increases that we've seen. But again, we're coming from a very low base, so you have to take that to perspective.
Right, exactly. But also with all that uncertainty that's happening right now, particularly with what's happening in Ukraine, between Ukraine and Russia, the war continues, unfortunately, sadly. And then, we've also got, as I mentioned at the beginning, continued shutdowns in China, because COVID apparently there is really starting to rage, and then they are really nervous about that, so they're sending everybody home. Quarantines are at another level. In Singapore, 25 million people are under quarantine. So with that in mind, do you still think the Fed could keep inflation at bay as we go towards the end of the year? We talk about CPI coming out, but it just seems there's too much uncertainty out there.
Well, they haven't kept inflation at bay so far, and I think that's the entire
plan.
point, right? Right. The entire point is that, and the whole question is, are they too late? And that's why we have this sort of these paths, these two separate paths. And when we see what the market is pricing in for the Fed funds rate, there are those that believe that the Fed should have started sooner. So when you look at what the market's expecting, it's expecting this push forward of the Fed fund rate hikes in a very aggressive manner. To your point, I mean, 50 May, 50 June. They expect a 275 at the end of the year. But when you look at that path, they also expect the Fed to ease by the end of 2023.
Right.
So what does that say? That says that because the Fed had waited, or maybe counted on the word transitory for a little bit too long,
right.
They have to go more aggressively and slow the economy.
Right.
And then there's others that believe that this is a base case move. That March will be the peak in inflation. When we head into the end of the year, it'll continue to trend down. And I think that's the important point, Anthony, to remember is that you don't have to see a negative, home price appreciation. You don't have to see a negative in terms of wages. The delta, they just can't go up by as much. And that's really what you pay attention to. It doesn't have to be a negative number. It just can't go by up as much as it has the past several months. That's really the key.
Yeah, that's a really good point. I think the average investor may expect things to just turn around very quickly as rates go up. And clearly that's not what you're talking about here. That's a great explanation for that, Leslie. But here's the other big question. Everybody's concerned about the big R word, recession. As we know, last month, the 2 and the 10-year yields inverted, and it was only for a moment, but a lot of times you look at past recessions, and many of them have been preceded by that inversion of the yield curve. Do you think it's a sure sign that a recession is coming, or are there other signs that show you that it is or isn't?
Well, I mean, I think there's several yield curves to look at, and that's really the key. First of all, I look at the yield curve as a coincident indicator, not a cause. But the 2s, as you'd mentioned, had inverted to, say, negative 10 basis points. It's steep by about 18 basis points now. But a week and a half ago, it was down to about negative 8. When you look at just the 2s curve, that, in our opinion, is not the only curve you should look at. As a matter of fact, that's not what the Fed looks at either. And here's the reason why. The 2-year Treasury is simply just taking what the market is expecting the Fed funds to be 2 years out. So it's very forward-looking, all right? Currently, the Fed has only moved 25 basis points. Granted, they'll probably do 50 in May. They'll probably do 50 in June.
But they have a long way to go.
But they have a long way to go.
Right.
And you have no idea really what's going to happen with that. So that's why it's really good to look at the 3-month 10-year or even the Fed fund 10-year. We prefer to look at the 3-month 10-year Treasury because that 3-month is really more of an accurate picture of what the Fed is doing in terms of the Fed fund rate. And what we look at in terms of that when the yield curve inverts is that when the cost of capital is greater than the return on capital for a sustained period of time, obviously that's a big drag in the economy. And that's really what the inversion does. But it has to be inverted really for a sustained period. 8 basis points is not material. It has to be much more than that. And we don't think you should look at just 1.2s. You really need to look at that 3-month 10-year to get a bigger picture. Now, to the question in terms of recession, we talked about this our last podcast.
We did. It's been coming up a lot.
It is. Is that, look, it's one of these issues, and we've discussed this, in our previous podcast. There could be a high probability that a recession comes, end of 23, 24. You can't rule that out. But the question is if it's a technical recession. 2 negative GDP quarters, not what we discussed last time, a great financial crisis or a COVID that really knocks the economy on its back, but one that just might be a little bit more shallow, and that's really going to be driven by the consumer, which from what we see today is strong, and we think will continue to be strong over the next year.
Right. Yeah, that was something that you certainly pointed out in the last time that we spoke was exactly that. That recession doesn't always mean what we saw in 2008 and 2009. There could be smaller recessions, just almost like a reset in a way, but not something as significant as what we saw, almost 15 years ago or so, or 16 years ago. So that's really important to talk about. Leslie, thank you. So let me ask you then, in this uncertain market, certainly there is uncertainty, although you've certainly helped us to see that there are some possibly more attainable things coming down the pike from the Fed, where we can expect, at least for the next couple of months, what they're going to be doing here. So with that in mind, and the volatility continuing, where do you see the best opportunity right now for fixed income investors who are watching today going, Leslie, what do I do here?
Well, I mean, unfortunately, the uncertainty is going to continue for quite some time, although the market has priced a lot in. They have. There's no question. They're pricing in very hawkish Fed funds rate. We're pricing in quantitative tightening now. really the only one thing that could really be the large headwind is if, in fact, inflation that we talked about really stays at this high single digits for the next several months.
Right.
Obviously, that would be quite an issue. What the market's grappling with now, as the Fed does quantitative tightening, is sort of the supply and demand imbalance. You've got one of the biggest players of that's been buying the market, the Fed, now out of the market, and someone needs to pick up the slack. So when we have the supply-demand imbalance really start to settle, even though the market's expecting this, opportunistically, when we hit this we hit a 2.78 and 10-year yield today, it's getting a bit overdone, in our opinion. We're not predicting the high. Over a year, we could definitely go higher, but the magnitude of the move from 1.5% at the end of the year to 2.78, 14 weeks in.
Right, that pace was.
That is just, it's really unbelievable.
Right.
So the opportunistically, what we're thinking about now is that, okay, we've had positions on such as floating rate, senior loans, since March of 2020, right? We've had it on May of 2020. We've had it on for a very long time because we were bearish a bit early. Now, although there is fundamental value still within the credit market in the sense of interest rate coverage, they term their debt out at a low level, defaults are low. When you look at the relative value of the sector, we feel it's kind of played its course. So right now, given where we are, we've taken a little bit of that, what we call the bearish allocation, back to neutral. And the reason why we've done that is because we've gone up so far in 10-year Treasury yields. And those sectors that are meant to be what we call more of the principal protection, like the short end, right, where you put your cash in, liquidity, are really that part, have really taken a hit this year because we've seen this big rise in two-year yields, right, which is why the 2s10's inverted.
That's right.
So we like those sectors now. It's sort of an up in quality, have a little bit more principal protection, and earn a little bit of carry. And of course, as you know, we have liked the preferred sector. We still like the preferred sector. We'd gotten it in February. We think over the long term, it's going to be not only great, yielding, but as things settle, you really start to earn that incremental carry, and you won't have the volatility that we've seen in the past. Because we do think that the majority of the yield rise is behind us. Again, it's too difficult to predict the high, and because the liquidity is not great in the market, but most of the headwinds of rising interest rates we think is behind us, and people should be neutral now, and really sort of on the edge of getting long, but not quite yet.
Right. So, and so you're saying basically those credit spreads that we saw go up so quickly because of volatility and illiquidity, maybe that'll start to level off a little bit?
They will level off a bit, but again, one of the things that we have to look at, even though the fundamentals are strong, this has been a very rapid market. When you think about March, COVID shutdown, accommodation very quickly, recovery very quickly, hiking very quickly, and magnitude very quickly.
Right.
That, we're not saying that we're at the end of the cycle, but the cycle's maturing. So you definitely need to watch out in terms of those credits, the allocations that you have, and just be selective. And one of the things that we've done with the senior loan side is and move to sort of like that IG, is just to go a little bit up in quality.
Right. We're creating new history every single day, especially as everything is so unprecedented. There's really nothing to compare it in our modern history, coming off of a pandemic into what we see now, and then of course this ongoing war that's happening in Ukraine. It's so hard to look back and compare it to something specifically. So thanks for giving us a little bit of a look ahead, Leslie. Good to see you.
You too.
Great.
Thank you.
Yeah, of course. Always love having you, Leslie. Great stuff to always talk about with you. And for more information from Leslie and the rest of the Chief Investment Office, visit our website at ubs.com/views. And you can also follow us on social media, LinkedIn, Facebook, Instagram, and Twitter, of course, are places where you can go for more info. And if you have any questions about your own portfolio or anything that Leslie and I spoke about today, make sure to reach out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. Remember to keep your eyes on what's trending. We'll see you soon.